type of candle indicating the market might be ready to turn. Biases to the long side, you might want to take advantage of a situation on the long side, more so than you would if the trade were short. But in this particular case, you would have tried to be long for this period. In this case, however, the market then did make a little dip. This was just yesterday's trading where the market, June 9th, where the market dropped back down. The predicted low was 1230, and so you should have been out in that using our strategy at 1220, and so that would have knocked you out. If it not knocked you out yesterday, of course, it would have taken you out in the early state trading today somewhere in this vicinity right here in 1220. So you're sitting there now without a position. Again, bias to the long side. You don't have any real strong things going on with the predicted differences down here. You don't know whether they're still on the strengthening side. So our bias is correct, but you do have a situation. Neural index has dropped to 0. So our hot market today is kind of one where it's a little bit of a sit and wait, see what's going to happen, and perhaps jump on board when you do get that opportunity to do so. It's probably going to have to rebound back up and get above that predicted high to get you back into the market. So that's kind of the mechanics of strategy that we use. We're going to look at, we'll go back here, and if we can pick up our computer again and make another switch over here, talk a little bit. We don't have time to cover all the markets, but we'll talk a little bit about one that a lot of people watch, and that is the E-mini. The other markets are no less deserving, but we're going to talk about the E-mini, and we're going to talk about this most recent period. We're not going to go way back and explain the whole strategy and everything in there, but we're going to cut back our time frame here. Let's see, maybe we can get 2 months. What we want to do is we want to get by, maybe we can even go down to a 1 month time and try to get by this candle that we had here that distorts everything on May the 6th, when a lot of things were happening, that kind of a unprecedented type thing, the flash crash or whatever you want to call it. So we're going to move past that and talk about the E-mini in the last month and what we're going to do and where we're at with it today. On February 13th, we're back here. Let's switch over to our screen so I can put some arrows and mark it up a little bit. It's always fun to be able to do that and talk about what goes on in the trade, what happens in the market, what's where should we be when we want a position. Okay, now we have a situation on May the 13th where we have the market has, as you know, it has kind of gone up a little bit throughout there, and it has kind of bounced back up from that May 6th day, and now we're in a situation where we need to kind of be looking at what is going to happen next. What are we prepared for? May 13th, the predicted low was 1157, so that means that we're going to be selling at 1147, which happens on the next day. And again, I'm drawing my line here. It's not the precise line, but just to give you the idea, short at 1147 in the E-mini. We could then, as we look at what's going on in the market, we can note that the market is in this downtrend. We're keeping our trailing stop above the predicted high for a period of time. We obviously wanted to keep that stop very close, because we don't want to risk. In this case, what we're talking about risking is 10 points in the E-mini, and that's only $500, but we don't want to risk any more than that. So we can move our stop, by this particular day. When we get down here to May 19th and we look at where the predicted high was here, we can then move our stop down to that predicted high of 1133 plus the 10 points, and it is now at 1143. So we entered the market at 1147. We have a stop at 1143, so that gives us some kind of protection against the market turning back against us. As the market moves on down, just to bring us up to speed, we get down to a period of time where the market is going to look like it's going to start to turn. First of all, we need to note the predicted differences. They have started to turn up. We get a little bump up in the predicted moving average, that blue line you see there, and then we get this nice long white candle here that indicates that the market is strengthening, ready to go up. Maybe it's time to shift our thinking. So on this particular day, in that May 27th day, the predicted high was 1077, which means that we would be buying at 10 points higher at 1087. Again, I'm going to draw a line here to kind of indicate where that is, and it's not going to be a precise line, but it's going to be somewhere right in there. We're 1087. If you remember, we were in the market. Our original trade was at 1147, somewhere right in here, and we have taken it down now to 1087. So not too bad a trade. We picked up 60 points there, and that's not too bad in the E-mini, or it's about $3,000. So not a bad situation at all for this kind of a basic type of a strategy. So after we've been bounced out, again, it depends a little bit in this case on where your bias is. At this point, frankly, it isn't really clear. Is this an uptrending situation overall like it is with gold, or is it downtrending? In the E-mini, that's not quite so clear. So, need to be prepared for almost anything that happens. Now, June the 2nd, we come to a candle here where we have a predicted high on June the 2nd of 1084. So that means at 1094, we're going to buy, put our stop at 1084. Remember, we're only going to take that 10 points. And, in this situation, if we look at what we did there and get in at 1094, and that puts it about right in there somewhere. And we're going to, get out if it drops back down to that predicted high, which is that 10-point range at 1084. And as you can see, that would come in about right in here. And, we're in there a couple of days, but then we're out, and we lost our 10 points on that. But better than a disaster. You take the losses, move on. It's one of those situations, if you nothing ventured, nothing gained, and you have to get used to dealing with losses because they will inevitably occur. In this situation, when you know that we're now out of the market, we got out of the market on that particular trade, and we now are looking at right here was 1088. The predicted low here was 1088. So let's say that we can turn right back around. If we're watching what happens during the day, we see this market has started, up high in the range or in the predicted range, and has moved steadily lower all day. And if you're watching the market fairly closely, you can say, okay, it has dropped through, and I anticipate if the market closes here, it's going to close, enough below that